Good morning to people in North America and South America, and good afternoon to people in Europe, and good evening to people in the East. Thank you for joining us. It's Jason and Adam with a live stream, and we are talking about the next great recession today. So, are you ready? Are you ready for the next great recession? Are you ready for impending doom? Are you ready for debt and destruction and the end of the currency and the end of US hegemony in the world? Hey, some of you might be welcoming that, especially George Soros. But Adam, what say you? Are you ready?
Oh, I think people always know that I'm a horrible pessimist, never have any optimism in my life. Yeah,
Seriously,
so,
you don't seem very pessimistic to me.
oh no,
You
I'm
gotta,
I'm I'm I look at the light side of life. No, so the main reason I threw this together, well not threw, I put this together was because I had a couple of clients who when I talked to them, they were very concerned about some issues that are going on in the world and saying, I don't want to invest into a big bubble, especially if things are going bad. And primarily, one of them sent me the
is that why they're
article.
not going to buy gold or Bitcoin? Because they'd be afraid they're investing in a big bubble
Yeah.
or
So
stock.
one of my clients sent me this article here from Yahoo Finance about J.P. Morgan relaxing some of the mortgage requirements with the housing prices on the rise. And he said, this is one of the reasons I'm concerned is because we saw, as you know, during the Great Recession, the big part of the bubble came whenever they relaxed their mortgaging standards and just said, kind of you get a loan, everybody gets a loan, like we were all at Oprah's getting properties. And so it was kind of like, hey, this is starting. How bad is it going to get? Should I wait? Should I not? And so I thought, well, let's dissect it and see whether we should or not.
All right. So before we get into biology class and we start doing dissection, which I remember that well, it was really gross in school having to dissect things. I was not a fan of that, but it is what it is. Guess that's the one job I couldn't do. Is I don't think I'd be a very good doctor. Anyway, before we do that, make a comment below. Let us know where you're located, where you're watching from, and who you think is going to win the U.S. election. Is it going to
Oh
be
gosh.
Joe Biden or Donald Trump? Uh, Clearly, we still have an election underway, as much as Adam might not want to admit it. Adam, do you agree or disagree with that statement?
I believe the results are in.
And what do they say?
I believe the results show we have a new president elect.
Nope,
Oh,
nope.
God. Do you really think the liberals are that smart that they know how to rig an election? Come on now.
Oh well, there are some pretty smart liberals. They're smart except for politics, but it took Al Gore, probably one of your heroes, 37 days to concede.
I'm not saying he has to concede and come out and say that, but it'd be nice if we could at least. I mean, Joe Biden already has some clearances just from being a former vice president. May as well keep him up to date, and it's not going to hurt anything.
Oh, you're complaining about the, not starting with the transition is what you're
Yeah,
saying, right? Yeah.
yeah,
Yeah. So might as well let him start transitioning. In other words, even though he hasn't been elected yet.
yeah. I mean, even if it turns out that things get flipped, well, no harm, no foul. Then
Yeah.
you just tell Biden bye.
Should
And
we give Biden the codes to the nukes, the nuclear football, as they call it? Well, he'd probably forget them anyway. I mean,
gosh,
okay,
that's the.
enough politics. I'll shut up now. I gotta heckle you a little bit. All right, so let's go into this. J.P.
Yeah.
Morgan Chase, the crooked bankster organization, J.P. Morgan Chase, and Jamie Dimon, who has, I think, committed a lot of bad, unethical deeds. But hey, aren't they all? This is the bankster world we live in, right?
So J.P. Morgan Chase and Company said that they're going on the offensive in mortgages as home prices rise, according to the bank's chief executive officer for consumer lending. So this was the beginning of, are we going to start having a bubble? So they came out and said, we have loosened some of our criteria. because they're walking back some of their constraints because they realize, prices are soaring. And if they don't loosen the regulations, then fewer people are going to be able to buy, and it's going to create, it won't be as fluid, and there will be fewer buyers out there. And so they feel that because of low rates and the economy being generally solid, which, as we know, it's good for some, bad for others, and the refinancing surge, and how it's up. Home ownership rates are up 4% from last year, 5% among those between 35 and 44. They feel comfortable loosening their lending guidelines.
Okay, so JP Morgan is loosening up. That's
Yep.
the takeaway, right?
Yep, they're loosening up. And so the question becomes, is this the start of another potential housing bubble that leads to a Great Recession?
Well, the question is, how loose are they going to be? I mean, are they going to be totally promiscuous? There's a metaphor, right? I don't think so. I mean, loosening up, they've overcorrected. I mean, these banks have just been, it's just too hard to get a mortgage, most of the time. I mean,
if you don't have perfect credit, it can be pretty hard.
What's that, Adam?
So if you don't have perfect credit, it can be pretty rough.
Yeah.
Getting a.
So let's ask our viewers what they think about this, okay? So just make a comment below if you're watching on YouTube, Facebook, or whatever, big tech censorship platform. Make a comment below. Do you think the banks are being too restrictive on giving mortgages and other loans, for example, or do you think the banks are being too lenient and liberal? Like, which side do you think they're on? In other words, is there a big default risk in the marketplace, viewers? We want to hear what you think. So comment below and let us know what you think.
And hello to Shannon Reese from Wilmington, North Carolina.
I love Wilmington, North Carolina. What a great place, Shannon. Do you know? Well, Shannon knows, of course, but Adam, do you know, and do the others know, that Wilmington, North Carolina is where they filmed Dawson's Creek, the TV show? I always wondered where that idyllic little town, but it was Wilmington, North Carolina. That's such a cool
I did not know that. My wife just recently started watching Dawson's Creek, and I watched half of an episode and said, "I'm good, thanks."
Yeah, you were done with that, huh?
Yeah. So, but I will say, Sharon or Shannon, if you want to start investing in your backyard, we've got some North Carolina properties you can talk to us about.
Oh, that's right, Adam. Good reminder. Okay, we got to make an announcement, folks. An announcement. You ready? So, listeners, we have a webinar tomorrow with some fantastic, brand new construction Charlotte, North Carolina investment properties. These properties work. They're good. So go to jasonhartman.com/Charlotte, jasonhartman.com/Charlotte, and register for that webinar right now as we speak at jasonhartman.com/Charlotte. Join us tomorrow. That's going to be a really good webinar. You're going to like what you see, folks. These are good properties.
Yep.
Okay, go.
So, all right. So, if we're talking about the generally solid economy and we talk about low rates, I figured I should probably go.
Solid is a relative term, by the way, of course.
Yes.
I figured the whole economy is built on a house of cards, as is every economy on Earth, pretty much. So we're speaking comparatively and relatively when we say that.
So let's talk to our rich uncle.
Jerome Powell.
Yeah. So I went and I listened to Jerome Powell's statement that he made back on, you'll see, on November 5th. So this is what I did with my afternoon, is I listened to the exciting poetry that is Jerome Powell.
Hey, listen, he's a lot more exciting than Alan Greenspan. Alan Greenspan was like watching paint dry.
So Jerome Powell is actually interesting to listen to when he just does like a Q&A. Yeah. This is a recorded, like a written speech, and it's kind of brutal. So y'all should be happy that I cut this up for you.
Okay, so you cut it up for us now. There's always a risk that the sound won't work, but I think you did this right based on what we talked about before. So let's give it a shot. Nope.
Darn, I can hear it.
So Adam, why don't you just do it the good old fashioned way? Just turn up the volume and put your mic near it. Okay.
Let's see.
A robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox.
All right.
Sure you will.
So the reason I put in summary, we're not doing anything for a while is because he clearly says when the crisis has passed,
right,
we will put it back in the toolbox. So it's not something that they're not just going to kind of peter off and be like, well, the vaccine's here. Goodbye. Everybody have a great night. And then the next time a recession comes around, or something like this comes around, they're going to go, oh no, what can we do? They're clearly putting it back in the toolbox. And they are, this is something that they're willing to do in the future during a crisis. Right. So our rich uncle is not leaving us anywhere in the near future.
Yeah, so. No, very, very interesting. I think, he is so different than prior Fed chairs. I mean, diametrically opposite of Alan Greenspan in the sense that he does not talk in code. He just comes right out and says, this is what we're going to do, and this is it, which I like.
Yeah, it's very nice. Ultimate Bargains over here said, even with perfect credit, getting a refinance loan is time-consuming nightmare of qualifying paperwork. We are refinancing primary residence to 2.5% interest, 30-year fixed, no balloon. The savings of the monthly payments work out to about 100% cash-on-cash return relative to the closing costs. Yeah, refinancing is a great option right now, but it can take forever. I mean, I was looking at potentially doing a refi on some of our investment properties, and they were telling me, straight up, it might be 60 days to get this done. So it's no fun out there in terms of timelines. So
no, it takes a long time. You get better service at a fast food restaurant than you do from a mortgage lender. But look, folks, that's the reason you have such a good rental market to some extent, because it's hard for your tenants also that might want to be buyers. And the glory in life goes to whoever's willing to put up with the most headaches and frustrations and be really persistent. I mean, think of it just like athletics, right? You watch the Olympics or whatever. These athletes have suffered, through pain and racking their bodies, and just lots of endurance is required to be a winner in anything. And this is just one of those examples. If it were easy, everybody would do it, right? You've got to take the extra step and do the harder thing, right, than everybody else. And you've got to also do it with the faith that you're not sure of the outcome in advance. And that's who the glory belongs to, folks, whether you be an investor or an athlete or anybody else.
Yeah. So now the question becomes, he talks about putting it away after the pandemic's over and put it back in the toolbox. The question you have to ask yourselves is, when are they going to put it away, right? When does the punch bowl get taken away? So Jerome Powell talked about that. Let's see.
By the way, I just put the link to the Charlotte webinar in the comments, and I think that only delivers to the Facebook pages, possibly. It may not deliver to YouTube. I can't remember. But it's jasonhartman.com/Charlotte. Go ahead, Adam.
With regard to interest rates, we continue to
Louder.
expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
So there you go. Those are the three things that have to be met before rates are raised. Maximum employment, which usually they consider in the 3 to 4% range. which we are 100% away from being there. Inflation reaching the 2% average over 12 months, which since right now we're at probably like maybe 1% inflation for the past year they've averaged, then we've got a while before that goes away. And then they're not only saying now they have to look in the future and expect inflation to reach that 2%. And we are nowhere near that. So we've got time left at the punch bowl before they think about taking it away.
Okay, so this party is just getting started, is the point you're making.
Yeah.
All right, let's get. I like that song by Pink. Let's get this party started. That's a fun. I haven't heard that song in years, but that's a fun song.
So all right. So
and yes, sorry. Sarah, I'm looking at the comments. I did mention Dawson's Creek. Do you like that show?
All right. So now we've got the debt. Everybody wants to know about the debt. So here we go.
In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. At this meeting, my colleagues and I discussed our asset purchases and the role they are playing in supporting the recovery. At the current pace, our holdings of securities are rising at a substantial rate of $120 billion per month, $80 billion per month of treasuries, and $40 billion per month of agency MBS. We believe these purchases, along with the very large purchases made to preserve financial stability in the depths of the crisis, have materially eased financial conditions and are providing substantial support to the economy. Looking ahead, we will continue to monitor developments and assess how our ongoing asset purchases can best support our maximum employment and price stability objectives, as well as market functioning and financial stability.
Okay, so here's why I put does buying treasuries really increase the debt?
You know, Adam, before you jump into that, I think we've got to give Jerome Powell the proper title and make sure everybody understands the company. And it is a company, it is a corporation that he runs, not a government agency, as many think. Okay. The company Jerome Powell runs, known as the Federal Reserve, is really the world's biggest hedge fund. It's the biggest hedge fund the world has ever known. It is the world's biggest investor. I mean, Bobby Axelrod on Billions or Warren Buffett in real life are nothing compared to Jerome Powell and the Federal Reserve. You know, it's a huge investment fund is what it is. And he is an investment manager with massive amounts of AUM, otherwise known as assets under management, AUM. That's what the Federal Reserve is. That's what Jerome Powell is. And Adam, you're kind of looking at me a little snarkily, like, oh, stop saying the Fed's a corporation.
Yeah, I mean, it kind of is, but it's the only corporation where all the directors have to be approved by Congress, and all of the at the end of the year, all of the profits have to be given back to the government.
Yeah, well, you could even make the argument that that's true of other big corporations to an extent. But
100% of their profits have to go back to the government.
Well, I was talking about both items you mentioned, the approval of the government, because, the big companies, they hire all their lobbyists, and, people are in or out depending on the favor they're getting from the government, right? So the government basically cuts off the favors if they don't like the CEO or the board or whomever, and they dole out the favoritism if they do like them, right? So that is, to an extent, also the dynamic there, admittedly to a lesser extent.
Much lesser.
The government taxes them and makes them give back some of their profits. So, it's not as true, but it is somewhat true. Go ahead.
All right. So the reason I asked, does buying treasury really increase the debt? So they're buying treasuries to keep the value up, for there to still be people in there buying so that it doesn't just tank. But in reality, if the federal government owns treasuries, all that means is they owe money to themselves. It's like having money in your left pocket and your right pocket saying we're broke, or we need more money and you have to pay me, and so you have to take it out of one pocket and put it in the other. So they're not growing the debt by nearly as much as they're making it sound in this situation. Because, can you pay yourself back if you owe yourself money? Yes, you can if you're the creator of the money. So it's not really adding to the debt in that regard. So the whole big we're exploding our debt problem or belief that he's talking about here isn't really as dangerous and bad as he makes it sound.
Right. But of course, there are many people who would totally argue with that, right?
Right. But it's pretty hard to tell me that the government adding treasuries that it bought to itself is harmful in the long run.
Right. But someone has to pay. I mean, money is not successfully created out of thin air. You either pay through taxes or you pay through inflation. Now, I believe, and feel free to expand on this if you like, because we really haven't done a show about one of your favorite topics of late, which is MMT, or modern monetary theory. But it seems, though, just a short little comment on it, is that it seems that MMT is a fantasy, because it seems like you can circumvent that whole idea that you don't have to pay it back through either taxes or inflation, right? I mean, you'll disagree, I'm sure, but why is that untrue?
Why you don't have to pay it back with taxes?
Well, yeah, I mean, look, anything created in the world has to be created out of something, right? There has to be some exchange of value, some sacrifice. You close one door to open another. You give up something to get something else. You create all this money to fund stimulus. That creates debt. The debt creates inflation, or the debt creates a need for higher tax revenue, or a blend of both, which is the path we've gone down for decades.
Why?
A blend of both.
Why does the debt make a bigger need for tax revenue?
Because it has to be repaid.
Who pays it?
What do you mean?
Who pays the debt?
Well, if it's government debt, the government has to pay the debt back.
Okay.
So when it sells a T-bill, right?
Yeah.
When it sells a bond.
I agree the government pays it back, but you and I are not personally in debt. And like, if you look at the big US debt clock, the whole, $100,000 per person or whatever it is.
Right. And hopefully you've all seen that amazing clock. Go and search that on DuckDuckGo. Don't do it on Google, because they're evil. But go to DuckDuckGo and search US debt clock. And if you haven't seen that debt clock, folks, it's truly amazing. It's got all these numbers in it. We should pull it up, and you feel free to share it on your screen if you want, Adam. And go ahead and do that if you like.
Yeah, I'm trying to see. But the thing is, I don't owe it.
Okay, so that really begs the philosophical question of, what is the government? The government is just a series of taxpayers that pay in to have a government, an organization. Look at it like a homeowners association, or a nonprofit membership organization, like the PTA or something, right? I don't know the PTA. I don't know how that works. So that may be a bad example, but whatever, say you have a club that you've created, right? Well, the club collects dues from its members to pay for its expenses, right? And the club could go into debt to,
but the
buy
club
a
is
building
nothing at
for
all
the
like
club, and the club has to pay that back, meaning the members
But
have
that's
to pay
not
it
the
back.
situation that we're in, though. We are in a situation where the club can't create its own things. The government creates the dollar. I don't owe it back because I can't create dollars. The federal government's spending is the receiver's savings. So it's the net public's or the private sector savings. So the public sector spending is the private sector savings. If you look at the debt clock, which I don't know how to pull it up on here, but the debt clock, the U.S. national debt is 27.264 trillion.
That's trillion with a T there, folks.
But if you look at U.S. total national assets, it's $156 trillion with
I would be very curious to see, because what you're basically sharing with us is the concept of a balance sheet. Okay. So I would be interested in seeing how do they calculate those assets? And I do agree with you, by the way, that the US has a ton of assets, both tangible and intangible assets. And I've done, many podcasts on that topic over the years, because I agree that it's not as bad as the doom and gloomers would have you believe. If you're listening to Peter Schiff and reading Zero Hedge all the time, and Jim Rickards, these guys are just always wrong. They're so interesting to listen to, but they're just like, when is all of their doom going to come true? They were telling us that in the 70s, the 80s, the 90s, the 2000s, the 2000 teens, and here we are in the 2020s, and they're still saying it. And yet there seems to be like very little consequence except higher taxes, more government intrusion in our lives, and higher inflation, whether hidden or unhidden.
Yeah. All right. We need to move on, or else we're never going to get to the actual good part that I have.
Okay. But you really got to just address that one thing. Okay. So go ahead.
All right. So let's finish with Jerome Powell real quick. Hang on.
Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox.
So that was the whole back in the toolbox thing again. So it's like we talked about before, they're not going away, and they will be coming back whenever times get bad again. So yeah. So the question is,
you consider that the good part? Is that the aha moment?
No. That's just the key part of that. Okay. Remember, as we move into the next,
I was worried that was the climax. Yours. I was like gonna go.
There's the good news, people. So we have to ask ourselves, what if it's another Great Recession right now? So I went through and I said, let's run the scenario. So I looked at the Dow Jones, because that's the sexy one that gets all the love from the media during the Great Recession. The absolute peak of the Great Recession hit, the peak of the market before the Great Recession hit October 2007. The Dow reached 17,356. So I said, let's pretend that today is October 2007 in the housing market. Okay. The trough was 3 years later in October 2010, or 3 years later, sorry, October 2010, you'd seen a 24% drop. So if you'd waited 3 years, it had gone down and come back up 24%. So I wanted to know, what if I bought a house today, and in 3 years, I bought a house at about a 20% drop? What would it look like?
Okay, this is good, folks. This might be the good part.
Yes, this is the good part. So let's say I bought a $250,000 house today with 20% down. So I got a $200,000 loan, interest rate of 3.75, very easily gettable. At a 30-year mortgage, I would be paying $926 a month with principal and interest.
That is, folks, that is a gift from your rich Uncle Jerome Powell right there. Wow. That is, I mean, get your cash register ready. You know, that is phenomenal. I mean, only $900 and something a month for a $250,000 house. You can see why everybody in the country is trying to buy a house right now.
Yeah. So then I looked, all right, if in 3 years from now, and I just went to the beginning of the year to make it easy for myself in the future. If on January 1st, 2024, I closed and that $250,000 house dropped 20%, and now I'm trying to buy it for $200,000. My interest rate's going to be higher, because obviously if we've had a 20% drop in the economy, interest rates are going to go up because of fears in the recession. And I just said, let's just say it's 6%. It could be higher. I was paying 6% for investment loans not that long ago. So if it's 6%, even at $160,000 mortgage, it's $959. So it's $33 a month higher in 3 years on a house that's 20% cheaper. And
if it ever gets 20% cheaper,
if it gets lower. So I'm playing the game of let's run the numbers the same as the Great Recession. But on January 1st, 2024, when I have the $200,000 loan, I have also paid down $12,000 in principal. I have had $23,000 in interest that I've paid that have been at least partially tax deductible.
Yeah.
And assuming I found a portfolio for one of our Florida properties that was around $250,000. The cash flow after 8% management, 8% vacancy, and 3% maintenance was around $250. So I said, assuming $250 a month, I have also gotten $9,500 in positive cash flow. So I've paid down $12,000 in principal. I've gotten a potential $23,000 in tax benefits, and I have $9,500 in cash flow in my pocket. On January 1st, 2024, my first payment is due on the other loan. That's it. And I'm going to assume about $225 a month cash flow moving forward, because my rent's probably dropped a little bit on that house. If I have to go down to $200,000, you've got a higher monthly payment, and you've got no principal pay down, no interest, no cash flow. So you're at zero. So that's what you've missed waiting the 3 years to try to buy at bottom.
Adam, I almost think it's easier to evaluate the missed opportunity by simply just looking at the return on investment directly, right? So here's another way to look at it. Okay, so how much is the down payment you made on that house? You said it's
it was $50,000.
So $50,000. And if you go to jasonhartman.com/properties and look at the pro formas there, where they've got all of the numbers, and if you want to know how to read that sheet and standardize your data as a real estate investor, just look at the free video, which, by the way, is an updated free video. Hopefully the update is there now. I think it is. I think it was updated just yesterday. There's a new version of that video at jasonhartman.com on how to analyze a real estate deal, how to read a pro forma. And, if the worst of these pro formas will show you an overall return on investment of, say, 25% annually. Okay. That'll be about the lower end. Some will be 30, 35%. But whatever it is, okay. Say it's, 25%. So you take 25% of $50,000. So that would be $12,500. And your time period was 2 years, right, Adam?
This is 3.
3 years. Okay. So I won't compound it, but the return on investment should be compounded to do it properly. But since I'm just doing it in my head, that's 12,500 plus 12,500 for year number 2 plus 12,500 for year number 3. So that's $37,500 return overall on a $50,000 investment. Now, disclaimer, okay, you have to understand that, number one, that might sound really phenomenal and ridiculous, like, I can't imagine that's really going to happen, Jason, you're just making that up. Well, no, you have to understand that income property, the reason it's the most historically proven asset class in the entire world, and it's made more people wealthy than any other asset class, for generations now, is because it's a multi-dimensional asset class, and you earn return in lots of different ways. A lot of it, it's like the old metaphor of an iceberg, right? Only a small part of the iceberg is above the water, the rest is below the water. Okay, ask the captain of the Titanic. Okay, so the iceberg, a lot of that return isn't directly seen, and that's why you have to know how to do the math. And that's what that free video, it's like a 30-minute video, got a little longer when I redid it in 2017.
Jason went long?
Yeah, you can't imagine me going long, right? And so that video will explain it to you, okay, how you earn that return. But I think that's just a really easy way to look at it. You could look at it the way Adam presented it too, either one.
I just wanted to present real numbers here.
Right.
This is the reason I did
instead
this.
of percentages.
Yeah.
Right.
So that's what you've given up the first 3 years. So
Good stuff.
now let's go 6 years out. If you look 6 years out from the peak of our market in the Great Recession, it was essentially flat after 6 years. So you're back to square one. So you've held on to an asset for 6 years and gotten nothing in the stock market. So if we look at the $200,000 loan we took out today, and the 100 on the left, and the $160,000 loan we took out on January 1st of 2024. If we run it through to where it's been 6 years from today, so on January 1st, 2027, the $200,000 loan, you have now paid down $25,000 in principal. You've had $43,500 of interest paid, and you've made $18,500 in cash flow. On your other one, your 3 years, you've only made $6,000 in principal pay down, $28,000 in interest paid, and $8,100 of positive cash flow because you're making lower cash flow. So the opportunity cost of just waiting those 3 years to try to buy at the bottom doesn't really exist, because if you remember, that's the 3 years that you've paid on this $160,000 loan that you've gotten over the last 3 years is worse. That $6,200, $28,000, $8,100 is worse than the $12,000 in principal pay down and $9,500 in positive cash flow from the first 3 years of your $200,000 loan. So did you really gain anything waiting those 3 years for the trough?
Yeah, no, I think that this, folks, see, look at, when you hear these talks about the value investing philosophy of Warren Buffett, right? And they talk about that in the stock market. And that is so, they say, you don't time the market, don't try and time the market, just buy quality and let it ride. And I generally agree with that philosophy. The value investing philosophy is sound. Benjamin Graham was Warren Buffett's mentor or inspiration. I'm not sure which way to say that. And the market timers almost never win, right? They win occasionally, and they got a few great stories, but usually people don't like to talk about their failures as much as their successes. So you don't hear about all the times they lost money, right? Or you don't hear about the dogs that don't bark and how much they would have made if they just left it in. Okay. So that's an issue. But with income property, Adam, it's so much better not timing the market, because you earn your return in so many different ways, right? You started off this presentation with that slide, which maybe we should just go back to for a moment. The IDEAL acronym. And that's a really old acronym in the income property world, but it doesn't even cover it anymore. IDEAL, okay? Income property gives you these ideal characteristics. It gives you income, it gives you depreciation, and that means good depreciation. It's a tax benefit. It's the best tax benefit ever, because it's a phantom write-off or a non-cash write-off. In other words, the property could be appreciating, it could be positive cash flowing, it can be doing great, and you still get a tax benefit, potentially that depreciation, right? And then you have equity growth, meaning your tenants pay your mortgage down. You have appreciation, meaning the property goes up in value, and so you get equity that way. And then to top it all off, you have L in IDEAL. You have leverage, meaning you can do more with less. Okay. So in Adam's example, you put 20% down and you have 80% paid for by the bank. You're using OPM. You're using other people's money. And this is just a partial list, by the way. This is an old thing. It doesn't have any of my advanced techniques in there, like inflation-induced debt destruction, IIDD, inflation-induced debt destruction. If you don't know what I'm talking about when I say that, go check out my podcast, The Creating Wealth Show. We go into that in detail. If you want to find exact episodes on that, just go to jasonhartman.com and type in inflation-induced debt destruction, and you will be wowed and amazed. Most people are. by the hidden wealth creator with income property that is in addition to what you see on the screen: income, depreciation, equity growth, appreciation, and leverage. But leverage is OPM, it's other people's money. It allows you to be so much more than you are. It allows you to be a 5 times bigger investor than you are. Okay, it's just a wonderful thing. Okay, Adam, any comments on that? But go ahead.
No, I agree. I didn't put the depreciation in there either, but you're missing out on 3 years of, roughly $10,000 a year depreciation for your property in the first 3 years of the $250,000 one. So
right. Yeah, so
been,
that's good. Now, understand that depreciation is a bit of a complex issue. We are not tax advisors. Our disclaimer is talk to your tax advisor. And of course, see the terms of service at jasonhartman.com and the privacy policy too. But yeah, taxes are a complex subject. But income property is the most tax favored asset class in America, the most historically proven asset class in the world. So Adam, go ahead.
Well, I was just looking through to see. Gosling's Nest in New York says, "I know this is off topic. Did you hear the latest? The nanny state in action and are looking to have all of us have masks on in our homes. Why are you guys not masked?"
Oh, that is so absurd. I can't.
Well,
I read that.
Have you read it? It makes more sense if you read it.
What was Pennsylvania doing that or something?
I don't remember what state it was, but essentially it's not if you're just in your house. It's if you have like a worker over, or if there's people who you're not usually around. It's essentially if it's like you're at an outdoor event, but it's in your house, they just ask that you wear a mask.
Look for my YouTube video on my YouTube channel about where I interviewed the mask doctor. He's an expert on masks, and he shows how the mask is making people sicker. Those masks are dangerous, folks. It's not as simple as it seems. There are many reasons, but one is that you're breathing in your own respiration, which is extremely unhealthy. The point of getting it out of your body is to get it out of your body. But number two is people spread more germs because they keep touching the things and fiddling with them. Okay. So the mask has a lot of problems. And of course, all the air still comes out. Okay. It's not like when you exhale, the air goes away. It still goes into the environment, but whatever. It's just a way for the government to control us. So.
Yeah. All right. So Ultimate Bargains thinks if the taxpayers
and
don't
say Adam's wife is a nurse, so
she wears an N95 8 to 12 hours a day, and
I don't know,
nothing bad has happened.
I can hardly wear it for 20 minutes at the grocery store. I hate those things. But
Ultimate Bargain says the Fed cannot put the toothpaste back in the tube. It will never increase interest rates.
Sorry. Hang on.
I don't agree with they'll never be able to increase interest rates again. It's going to be a while. I will grant you that, but we will see higher interest rates again. They can't, it's eventually the economy will turn around and start going back to where it was, before COVID. And when that happens, they'll have to start changing things in the economy, or else it'll run too hot and inflation will skyrocket.
Yeah, well, the problem is, and what the people who disagree with that statement, Adam, what they say is that, like our viewer said, you can't put the toothpaste back in the tube. They can reel that in, but it's not nearly as easy as it sounds.
Oh, I agree.
Okay. And the one great example we have of that is Paul Volcker, who recently passed away. We talked about him many times on the podcast. He was the Federal Reserve Chair in the early 80s. Okay. And he was the one that broke the back of inflation by raising interest rates to astronomical highs, because inflation was just rampant, and it was ugly. I mean, that was really hard to do that. What Paul Volcker did, it was hard to, number one, have the courage to do it, because he was so hated at the time for doing it. It's like making someone take really bad medicine, and so it's very damaging to raise the rates and manipulate the market that way to stop the inflation. And these things have a spiral life of their own. So it's not like, I mean, Jerome Powell just glibly sort of says, the same way Ben Bernanke said it, is, we'll just put the tool back in the toolbox and everything is going to be okay. Yeah, well, not quite.
Well, but even if the Fed doesn't end up raising their rates, eventually, other parts of the economy will get good enough that they're going to have to raise the rates to get investors to come in and start buying the mortgages. So the rates will have to go up in order to get the spread that they need.
Sure. But
so, I mean, the Fed not raising their rates isn't that big of a deal.
Yeah.
So Eccentric says, now that Biden may be president, are you guys learning Chinese, as that will soon be the national language of the world?
Yeah. Yeah.
I haven't gone that far yet. Are you learning any new languages, Jason?
No, definitely not.
We got a ways. Eccentric also says, have you seen the news about the California law about foreclosures? People buying homes for personal use will be able to underbid investors. I haven't seen that.
Yeah, I have seen that, and I've thought about it. And of course, it'll be another failed disaster, Gavin Newsom stupidity. That won't work for a million reasons. We'll talk about another day because it'll take too long.
So let's see. We didn't get a ton of questions today. So I think.
Any comments?
Yeah. Craig Crippen doesn't agree with us.
Craig says Fed raising rates is a huge deal. Raise equals economic collapse.
I don't agree with that. I mean, the Fed rate was significantly higher than it is now just 2 years ago, and we didn't have an economic collapse.
Well, it depends. It's all a matter of degree. It's really just all a matter of degree and speed at which they do it. So, see, Paul Volcker did it. He did it quickly, and he ended the inflation problem. But it was very, very painful, folks. So we'll see. We'll see what happens. Okay, Adam, is that your last slide?
Yes, it is.
Put it back to the first slide, or that slide's good. Leave it there. That's a good one. Good stuff. So, folks, we will wrap it up, but join us tomorrow for our Charlotte webinar. You're going to learn some good stuff. I have a little teaching at the beginning of that webinar, and that's at jasonhartman.com/Charlotte. And Kim just posted something. She said,
why do you think people buying houses in Seattle like it crazy?
Yeah.
I don't know why people are buying in Seattle.
What?
I don't know why people are buying in Seattle.
Yeah, they're crazy. They're crazy. They're crazy. So that is not a good idea. Don't do it. And Craig says, well, there's a couple more, Adam, there. Just grab those at the end.
Oh, they're coming in now.
Yeah.
Craig said Volcker was able to because the country had way less debt then. We are not restrained in our spending by the debt. The debt, like I said, is just money that we're holding as assets. I mean, the federal government creates the dollars and puts them out there. Our taxes don't actually pay for anything. The only reason they have to tax is to give our currency value and to potentially remove to try to get us from not using some of the resources that are needed. The danger of inflation comes when there's competition for resources. And we're not experiencing that right now. Yes, there's run-up.
Housing market.
There are some areas where it's happening, but the government spending is not what's causing that. Like, government's not going in and trying to buy up all the lumber. A big part of our lumber problem right now is the fact that COVID shut down a lot of the production for a while.
Yeah, but even after that, now those
right, but
that story, right?
But yes, I heard you talk about it. They still have to ramp up the production.
They still over each other. Go ahead.
They still have to ramp up the production. We still have tariffs coming in on all of the lumber that's coming in from Canada. So it's not the government purchasing and the government money coming in that's the issue with that. It's the other parts around it that's creating the run up in cost.
Yeah, well, Yeah, okay, this is just too complex a subject to debate today, but we'll talk about debt and inflation, and I'm a little bit in the middle of this. I don't think it's as easy as Adam makes it out to be, but I
I
don't think
don't make it out to be easy. The theory itself is easy. The implementation is hard.
yeah. Well, I also don't think it's as bad as the doom and gloomers like Jim Rickards and Peter Schiff would say either. So I'm a little bit in the middle about it. So good stuff. All right. Anything else? Any more before we go, Adam?
Looks like we're just debating money and taxes now in the comments. So I think for today we're
All right.
good. We can get down to the money and taxes stuff maybe in 2 weeks.
All right. Everybody, thanks so much for joining us. We really appreciate it. Be sure to like and subscribe if you're watching on YouTube, and do the bell notification so you'll catch those impromptu live streams like the one I did on Monday. And also, we will see you tomorrow at our Charlotte investing webinar. This is a totally new one. It's a market we haven't been in for several years. I made some great money in that market. I profiled an exchange I did out of Charlotte into 2 more properties in Memphis. And this is just a great market. It's been pretty hard to access. So we've got brand new construction there, and some teaching we're going to be doing on that webinar as well tomorrow. So join us, jasonhartman.com/Charlotte, and we will see you there. Thanks, everybody, and happy investing.